Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of how compound interest can transform your financial future. Ever wonder how your money can make money? That's the magic of compound interest. Often called the eighth wonder of the world, this simple yet powerful concept has been helping people build wealth for centuries. It's not just about saving, it's about letting time and growth work for you. Whether you're growing a savings account or planning for retirement, understanding compound interest can completely change how you think about your finances. What is compound interest? Compound interest is one of the most powerful tools in personal finance. It's the process of earning interest on your initial deposit, or principal, plus any previously earned interest. Over time, this creates a snowball effect, where your money starts generating its own money. Whether you're growing a savings account or working towards a long-term financial goal, understanding how compound interest works can make all the difference in building wealth. The basic principle behind compound interest. At its core, compound interest revolves around reinvestment. When you deposit money into a savings account, for example, the bank pays interest based on the amount you have. With compound interest, that earned interest doesn't just sit there, it gets reinvested into your account, earning even more interest moving forward. Over time, this cycle of reinvestment creates exponential growth in your total balance. Here's a simple way to think of it. Imagine planting a tree. At first, it's just a seed, and it takes time to grow. But as the tree matures, it produces seeds of its own that grow into additional trees. Soon, you have a whole forest, all from that one seed. Compound interest works the same way, using your initial deposit as the seed. To break it down mathematically, the formula for compound interest is A equals P, 1 plus R, N, caret, NT. Where A equals the total amount after interest. P equals the principal amount, your starting balance. R equals annual interest rate, in decimal form. N equals number of times interest is compounded per year. T equals time in years. Let's say you start with $1,000, earn 5% annual interest, and the interest is compounded yearly. After 10 years, your balance grows to $1,628.89, not just $1,500, which would have been the case with simple interest. That extra $128.89 is the magic of compounding at work. Compound interest versus simple interest. What sets compound interest apart from simple interest is its ability to accelerate growth. While they both involve earning interest, simple interest is straightforward, it's calculated only on the original principal. Compound interest, however, builds on itself, leading to significantly greater outcomes over the long term. Here's a quick comparison to highlight the differences. Example, $1,000 invested at 5% annually for 10 years. Simple interest, only the principal earns interest. Formula: interest equals principal times rate times time. Calculation: $1,000 times 0.05 times 10 equals $500. Total equals $1,000, principal, plus $500, interest, equals $1,500. Compound interest. Both principal and accrued interest earn interest each year. Using the previous formula, total equals $1,628.89. In this example, the difference is $128.89. While that might not seem like a huge amount now, consider what happens over 30 or 40 years. Compound interest turns a slow and steady process into massive growth, especially when combined with regular contributions. See how the gap widens over time. Compound interest uses momentum, while simple interest stagnates after calculating the initial growth. If you're wondering why this matters, think about financial goals like retirement or saving for a major life event. Compound interest thrives on time. The longer you allow it to grow, the more dramatic the results. Simple interest, on the other hand, doesn't reward patience nearly as much. The history and origin of compound interest. Understanding compound interest isn't just about looking forward, it's also about appreciating where it came from. The roots of this financial concept stretch back thousands of years, evolving from ancient trade systems to a cornerstone of modern banking. By exploring its origins, we can better appreciate how it became the wealth-building powerhouse we know today. Compound interest in ancient times. The concept of earning interest on money isn't new. In fact, civilizations like Mesopotamia, Egypt, and Greece were laying the groundwork for compound interest long before modern banking existed. These ancient societies relied heavily on trade, and lending money was a natural part of that. In Mesopotamia, around 2000 BCE, written records like the Code of Hammurabi show us that interest was charged on loans, often tied to agricultural transactions. Farmers, in particular, would borrow seeds or grain with the promise to repay it with a percentage added, essentially functioning as early interest. While this was primarily simple interest, evidence shows that these societies were aware of how unpaid interest could accumulate, resembling the concept of compounding. The ancient Greeks also understood the power of compounding. Philosophers like Aristotle criticized the practice of charging interest, but financial contracts of the time often included the concept of charging interest on unpaid sums. Wealthy citizens and city-states lent funds for ventures like trade expeditions, and the repayment often included terms that indirectly reflected a compounding mechanism. Even in Egypt, archaeological discoveries reveal loan agreements that included the potential for accumulated interest. The idea may not have been as sophisticated as modern compound interest formulas, but it's clear that these early societies recognized how money could grow over time when reinvested or carried forward. Development in modern financial systems. As global trade expanded and economies grew, the role of compound interest became more prominent and structured. By the medieval period, banking systems began to emerge in Europe, heavily influenced by the practices of moneylenders and scholars from Islamic and Asian cultures. The Renaissance period brought significant advancements in finance, particularly in Italy. Families like the Medicis built wealth through sophisticated banking systems that utilized compounding to grow their capital. During this time, the idea of compounding became more formalized, as mathematicians like Fibonacci worked on theories involving the growth of investment over time. His famous sequence, while unrelated to finance, touched on exponential growth patterns similar to those in compound interest. Fast forward to the 18th century, and modern banks began institutionalizing compound interest. The Industrial Revolution drove the demand for capital investments, where banks played a key role. Loans often included terms for compounding interest, allowing banks to grow their reserves while businesses gained access to funding. Mathematicians like Jacob Bernoulli refined the mathematics behind compounding, creating formulas that are still used today. In more recent history, the rise of personal savings accounts, retirement funds, and investment tools like mutual funds or bonds has made compound interest accessible beyond banks and elites. Today, it underpins everything from credit card debts to long-term investment strategies, shaping how individuals and institutions alike grow their wealth. Compounding remains one of the simplest yet most transformative ideas in finance. Its journey from ancient grain loans to computerized savings algorithms shows how a basic principle of growth can adapt, endure, and remain relevant across generations. How compound interest builds wealth. Compound interest is the cornerstone of building lasting wealth. It's not just about setting money aside, it's about allowing it to grow exponentially over time. By reinvesting earned interest, your savings can snowball, creating meaningful financial returns. The beauty of this concept lies in its simplicity, yet its impact can be life-changing, especially when paired with time and consistency. Here's how starting early and giving your investments time to grow can unlock extraordinary results. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.